Hello friends, good evening. So let's start the content on class 12 NCERT, and this will be the last class with respect to NCERT session on economics. So today we will be having the content relating to macroeconomics. I just want to establish a point here. The book in class 12 is divided into two categories. One is microeconomics, another is macroeconomics. We will not deal with something called as microeconomics as it is nowhere relating to the aspect of syllabus area. We will just ignore that and we will move on to macroeconomics. So what is the individual firm production cost, distribution cost, how they are doing, what is cost per unit, all those things whatever we cover in case of microeconomics, that will get ignored in case of our current area with respect to this topic. And now we will have this discussion relating to the content on the so-called macroeconomics of India. In this topic, generally speaking, we are having the presence of 6 chapters put together. Number 1, the introduction. Number 2, the basic concepts, that is national income accounting. Number 3, money and banking. Number 4, income determination. Number 5, government, the function and scope, that is with respect to the fiscal policy of India. Then we will deal open economy, that is balance of payment, balance of trade, foreign exchange deficit, forex market, etc. Once we are done with all these things, we can move on to the quiz area so that we cover every aspect of syllabus in a detailed perspective, right? So these are the topics which are going to start. So before that area, right, so July 13 is the batch date. So the batch will get kickstarted by July 13 and it is a complete 1-year online course as such. So you can contact the academy, they will give you all insights. Additionally, one more information is there for you. Okay, so till 15th July you are having flat 25% discount on all packages relating to general studies and optional area, and we are having a great amount of GS batches to a largest number. Therefore, if you contact according to your demand and time availability, the batch will be accommodated and you will be getting a discount also. So SRIRAMS will be the coupon code as such to commence the syllabus preparation in case of this area, and you can just contact the academy. They will give a detailed description of how to proceed for these admissions. Next, the question will be relating to our preparation area, and in that we will start something called as the government of India's macroeconomics to a large extent. First thing is that what do you mean by this area which is called as macroeconomics? One thing which I want to establish in this topic is, yes, after completing of this area, there is a quiz also based on some of the questions taken from NCERT. That also we will deal in due course of time. Generally speaking, we divide the course of economy into two categories, in which number 1 it is called as microeconomics, and number 2 we deal with something called as macroeconomics. So micro and macro are two typology with respect to economics area, and we are deeply concerned with macroeconomics. So what do you mean by this macroeconomics? It will deal about the entire nation to a larger perspective. It will speak from the arena relating to the domain of what is the employment rate of India, unemployment rate of India, poverty in case of India, population index in case of India. All these things we will have a detailed description. Then only such a study can be labeled as macroeconomics. If I deal about a single firm, the cost of production, cost of manufacturing, what is the break-even point for a single commodity, I am dealing something called as microeconomics. So here our chapter will greatly focus on what do you mean by called as the so-called macroeconomics. So in this area, we will try to have a look upon all the aspects one by one. In that, first priority we will give to the founding father of economics, none other than the great hero Adam Smith. So Adam Smith happens to be the founding father of modern economics, and he is been credited with this particular title. And this man is a Scottish economist, and he has given a book also called as Wealth of Nation. I'll simply tell you what is the idea of this person in case of giving the theory on wealth of nation. According to Adam Smith, wealth creation should be the only goal of the government. Nothing more than that is required. More the wealth they create, more happy they will be. Therefore, this particular person created a historical blunder by ignoring the element of other dimensions what a government is supposed to do. He thought that asset creation or wealth creation is alone enough to have a great amount of prosperity. This thinking, what was done by this man, again resulted in disaster. I'll give you one simplest example. American economy was based on this particular model in which they had the idea relating to the content on wealth creation. They never worried about what will be the repercussion, the consequences. At last, what happened in the year 1929, when the capitalism was being permitted to an unlimited extent, at last it resulted in something called as the so-called failure of system. When system failed, Great Depression happened. They never ever assumed that a country like America will be having a failure to such a large extent. So this particular model is based on the assumption that we need to go for maximum amount of wealth creation, and that is the only content of Adam Smith theory. And again, this theory is being supplied or supplemented after the failure of the economy way back in the year 1929. What happened? They thought that someone has to come and help us, and that help was given by John Maynard Keynes, and his theory is called as General Theory of Employment, Interest and Money. So EIM. Normally we will be having EM, I know. You just reverse the last word. EIM, General Theory of Employment, Interest and Money. This theory was given in 1936. In this they say we have to create some amount of employment, and government cannot wash off the responsibility completely. They are supposed to do the element of some activities which are very much required. Without doing the element of governmental support or governmental role, we cannot sustain. That was the opinion given here by this person. Therefore, J.M. Keynes is again seen as the father of modern economics. So classical economists, we can take Adam Smith, but for modern economics, the great input was given by this person. In this area, we will try to know what do you mean by something called as capitalist country. So, the question on capitalist country. Any country which is permitting the private player to operate freely without any amount of disturbances, that will be called as capitalist economy. On the other hand, entrepreneur is any person who is willing to take a risk and do a business, will be called as entrepreneur. So, what is the difference between entrepreneur and a business person? Entrepreneur and business person in the sense, business person will buy the mangoes in the market, let's say for 40 rupees. And sell to customer for 50 rupees. He will make 10 rupees profit, which is otherwise called as 25% gain for the seller. On the other hand, if you take entrepreneur, he will buy the mangoes for 40 rupees. He will make mango juice and mango shake out of it and sell it for 200 rupees. In this area, the profit earned by him is enormous. Almost 5 times he is making the profit. This is the difference between entrepreneur and otherwise called as a business person. So, entrepreneurs are those people who are willing to take a risk and proceed forward. The only difficulty what an entrepreneur will face is that he will not have the capital to do the business. Otherwise speaking, he will have the element of idea to do all the works. And here the resources are being subjected to natural resources. That means something available as a gift of nature, and the amount of effort what an individual is doing will be called as labor, and whatever amount of money he is earning is called as revenue. The amount of the excess money over the cost of production what remains in the hands of entrepreneur will be called as profit. And for doing all these things, when the amount of investment is being made by the entrepreneur, that will be called as investment expenditure. So do understand this formula. Next is called as the wage rate. So wage rate is the labor which is sold and purchased against wages, is referred as wage labor or wage rate. So wage rate or wage labor is the amount of compensation, generally speaking, what we pay to the working class section. And again we have another content which is called as exports and import. You know these basic terms. Generally when economy is involving in great amount of sending the goods outside their country, it is called as export. When the economy is receiving many goods from other country, it is called as import. So export and import are two dimensions, and that too in the present globalized world, ignoring these things can never happen. So this is the input relating to the domain on the so-called issue relating to exports and import. Therefore be specific in this area, there is no doubt in that. Again, this chapter is based on these simplest area. So we all know, I think this is one topic, factors of production. The 4 factors of production put together will be called as land, labor, capital, organization. The place where we have to start the business is land, for which we pay rent. Labor will be the human capital working over there, and we pay wages for salary. Capital will be the investment required to start a business, and organization is none other than the entrepreneur who takes a risk to start the business. So this is all about the question on chapter 1. With that we can move on to next area, chapter 2, otherwise called as national income accounting. Generally, this chapter revolves around a very vital area where they speak about the content on how to go forward in terms of this national income accounting, how this can be subjected to an acceptance. In this topic, the logic what we are having is generally we need to account all the transaction. We cannot remain silent. Any transaction happening, we need to account it, and that accounting will be helping us in terms of this chapter, which is called as the so-called national income chapter. I'll tell you one by one how to understand the formula. Maybe with that insights, when we jump into this chapter, we can have a clearest knowledge relating to this chapter to a very large extent as such. So in this topic, just a moment, I'll tell you one by one the content with respect to this area. Okay, so first is that in case of this national income, we all go by something called as GDP. So what do you mean by GDP? What all we'll be learning in this chapter is called as what do you mean by NDP. Next, okay. Next we have something called as GNP. We have something called as NNP. Then what do you mean by market price? Then what do you mean by factor cost? Then what do you mean by subsidies as such in this chapter? Then we will know what do you mean by net factor income earned from abroad. After knowing these things, we will know what is per capita income as such earned by a particular person in a single country. These are the basic things which we will be knowing under this chapter. And here, once we are being subjected to these area, it again conveys a louder message that the question of GDP, if you understand in this area, you will not have any amount of apprehension as such. So in this topic, please understand, first is that we speak about the word called as GDP. I am giving so much of space because I will explain each alphabet and the meaning linked with these alphabet as such. First thing is called as gross. So what is gross? For instance, you will be receiving salary when you work somewhere, which is called as gross salary, and you will take home some salary which is called as net salary. So gross salary, let us say if it is 1 lakh, your take home net salary will be around some 77,000. 1 lakh is the gross and net is 77. This indicates that the question relating to the aspect of gross and net is having some amount of deduction, and that deduction can have any name. It can be PF, it can be tax contribution, it can be anything as such. Therefore, what is the universal formula? Universal formula is net is equal to gross minus depreciation. Therefore, in this area, please be very specific. What do you mean by net? net is equal to gross minus depreciation. This is the input with respect to the concept which is considered to be the concept on net. So we all know what do you mean by net. Always net is equal to gross minus depreciation. This we can remember lifelong till we have the element of our knowledge in economics. In that, first thing is called as GDP. So first is gross, number 2 domestic. What do you mean by domestic? When goods and other services are being produced within the boundary of India, it will be called as domestic. And the word product denotes the final goods which is coming into the market. So G means gross, D means domestic, P means product. Gross means we know something we have to subtract. D means domestic within the geographical boundary of a country. P means product, which means final goods and service. It will not have any intermediary goods and service. So intermediary goods and service will not come here. For example, when there is the element of shirt manufacturing, we will not add cotton separately, yarn separately, color and dyeing separately, buttons separately, packing separately, and then final cost separately. No, we will take only the final cost, because if we add these things again and again, it will result in double counting, and which is not considered to be an ideal method to do the calculation. Therefore, our methodology in case of GDP calculation will never ever take into intermediate goods, and we are more concerned only to go by the aspect of final goods and service as such. Now, the question on GDP is over. Generally, what is the formula we have for the GDP? GDP is equal to C plus I, C plus, one second. GDP is equal to C plus I plus G plus X minus M. C plus I plus G plus X minus M. C means the expenditure made on consumption. I means expenditure made on investment. G means government expenditure. X means export. M means input. These are the area relating to the aspect of the so-called GDP formula. So what is GDP? The total amount of goods and service produced in a country within 1 year of time without duplication and expressed in terms of money is called as GDP. So the content here is very simple. So GDP is based on the formula where we have these things. So GDP formula is very simple. We go by the input that the question on GDP formula is subjected to the acceptance of consumption expenditure, investment expenditure, government expenditure, and the net of export minus import. This is the formula for GDP what we are having. Additionally, in this GDP, suppose if you want to go for NDP, what is the formula? I told you always net is equal to gross minus depreciation. Therefore, NDP is equal to GDP minus depreciation. In this area, we are very well strong as such. Next one, what do you mean by GNP? We get this also as a formula. What is gross national product? Here we go by GDP plus NFIA, a new term for you, NFIA. What is NFIA? Net factor income from abroad will be called as NFIA. Why we are having NFIA and how to remember NFIA? For this, for every student, I'll give you a small tip to remember. What is the tip to remember NFIA? In this area, please understand the word TIP, which is called as tip, is the tip to remember NFIA. Why? Because T is equal to trade balance. Next, I is equal to interest on borrowing. P is equal to private remittances. If you make the summation of all the three, that is called as the so-called NFIA. So NFIA will be subjected to these three areas. Do remember these point, very important from examination perspective. What is trade balance? Whether our export or import, whichever is higher, will give the trade balance. Let us assume India is doing large amount of export, very minimal amount of import, then we will be having a good amount of profit margin. Our trade balance will be positive. But what we are doing, exports are less, imports are more. Therefore, in India, the trade balance is always negative in nature. Number 2, interest on borrowing. Whether India has given loan to many and they are paying interest to us, or India has taken loan from many and we are paying interest to them. Without knowing economics, we can tell we will pay more interest than receiving the interest. So, interest on borrowing also for India, it is negative. Private remittances, Indians working abroad and sending money to India, foreign people working in India and sending money to their parent country. Among the two, if you ask me which is happening to a larger extent, we can tell people of Indian origin working outside and sending money to India are large in number than the people who are coming from foreign country and staying in India and sending their income to their country. Therefore, private remittances are positive in nature. As first two factors are negative, only third is positive. Overall net factor income from abroad is negative. So what we will do, when you go by the formula of what do you mean by gross national product, it will be called as GDP plus NFIA. In this area, let us assume if our GDP is equal to 100. Now we have to plus something, but our NFIA is in negative. Let us assume our NFIA is 30 in minus. So overall GNP will be only 70. Most of the countries will have net factor income as positive. When net factor income is positive, what will happen? Here we will be having GDP as 100 and foreign income as 30. Put together 130 will be the answer. That is what we expect. But here what happened? This particular area got diluted in case of Indian example. So in case of India, always remember GDP will be more than GNP. But in many countries, GNP will be more than GDP. So when they ask a question, be specific on this area. Do understand the concept, what they are teaching in GNP and GDP. Don't try to by heart it. Please understand the concept. Still, if you find any doubt, send a text message in the live chat. I'll help you to understand these area. And now in this topic, when we are going for the aspects of the so-called GNP. Now, in this GNP, how to arrive the next formula called as NNP, Net National Product. For that, the formula is GNP minus depreciation. GNP minus depreciation is the formula. So what is here? GNP minus depreciation will give us something called as NNP, and this NNP, when they initially expressed at factor cost, this was called as the national income of India. Right now we have gone for the market price mechanism, but earlier before 2015 we had only the factor cost to define something called as the so-called national income of India. So here national income, right now why they have changed the methodology in GDP is that the international comparison is possible only when we go by the factor market price and not by the factor cost. That is the reason we have changed these commodities. Generally, what is this factor cost and what is this market price? Many will be having doubt. Let us make this concept very simple. Factor cost is what is the cost involved for producing the goods and service. Let us assume it will be the cost for the labor, the cost for rent, the cost for payment of interest to the bank loan plus the profit margin. All these things, when you sum up, the final summation will be called as the so-called factor cost. In this area, what is market price then? Market price is nothing but the total amount of factor cost involved, plus we need to add the indirect taxes whatever we are paying to the government, and then we have to subtract the subsidies received by the firm from the government. These items will give you market price and this will give you factor cost. Do understand these two area, very important from examination point of view. On the other hand, when we are being subjected to, let's say, per capita income. What is this per capita income? Generally speaking, when you take the total income of a country and divide it by the total population of the country as per the recent census, what we get is called as per capita income. So in these topics we can tell that national income or per capita income or GDP, GNP, NDP, NNP, factor cost, market price, whatever it is all based on the simple concepts and not based on complex areas as such. So now we'll just jump back to this chapter which is called as the national income accounting as such. So here let's go into the content one by one. So we speak only on the aspects of final goods as such. What is final goods? For example, when you speak about the element of a pen, pen is a final goods. But before that, the plastic purchasing, ink what they purchase, the nib what they purchase, the color what they purchase to paint the pen, all those things will not come under the aspect of the so-called definition of the final goods. Final goods are those goods which are subjected to finality. There is no amount of other chances in this area, and that is why we call the goods as a final goods. Okay, so in this topic, let's be very clear to understand the content on the topic called as final goods. And the goods are being divided into two categories. One is consumption goods, other is called as capital goods. Whatever goods are being purchased for direct usage by the end customer, that will be called as consumption goods. On the other hand, yes, Aditya Sabal, so we have a doubt. Please share your doubt, I'll help you. Right, so doubts are there, please as such share it in the chat itself. So in between here and there, when I find the time, I will come and assist you in case of the doubt topics. So consumption goods and capital goods are there. Consumption goods cannot be reconverted, but capital goods can be used to make more amount of commodity, and that is where we have the term called as consumption goods. Then we have something called as consumer durable, like what we are using, like in terms of the regular commodities in our house will be called as consumer durable, and intermediate goods are those goods which are being used to make a final product. For example, thread, cotton yarn, or the dyeing, all these things are intermediate goods. What is the final goods? The shirt what we are wearing will be called as the final goods as such. Next is that in this chapter we'll be knowing about the concept of stock and flow. So stock is something which we can as such measure it on a particular day, and flow will be subjected to a continuous amount of change as it is always having the element of dynamism. In this area we'll also know about something called as depreciation. What do you mean by depreciation? Depreciation means wear and tear. Whenever any machinery is being put to use, whenever we have some amount of machines being used, that machine, if it is having some amount of lifetime, that lifetime before it completes, every year the value of the machine will come down, which is called as depreciation. And this formula, please understand, net investment is equal to gross investment minus depreciation. So always net is equal to gross minus depreciation. Do understand that topic, very important from examination point of view. Next is that we have something called as the circular flow of income. So here what happens, the firms will produce the goods and service, and households will be making the payment as such. Again the firms will go for the production. So household will consume, firm will produce. So production and consumption will happen simultaneously, and this is what is called as the so-called circular flow, what we are following in case of every economy as such. And here the question relating to the aspect of measuring the income can be done by way of first method called as expenditure method. all the expenses made by the individual, when you sum up, we can get the element of the so-called final national income. Or we can go by the output of all the industries, whatever they make it. That method, if you follow, it is called as product method or output method. At the end, when you measure all the income earned by all the members, that will be labeled as income method for the aspect of calculation of what we term it as the so-called national income in case of India. Next is that we also go by the next area called as GVA. What is GVA? GVA is very simple. For example, gross value added. Each stage when a goods is subjected to some amount of modification, in every stage what are the modifications done by them will be called as gross value added. In that, when you subtract the depreciation, we get something called as net value added. This we are using right now in case of the national income calculation. And then again, so these are not the terms required as such. All these formulae and these content all do not read. It will not have any amount of helping impact for the examination. Already I said what is income method, expenditure method and the output method. That is enough to understand the answer as such. Next, so we have seen already what is this GDP. We have seen what is this NNP, GNP, factor cost, personal income, everything we have seen. At last, what is the formula for personal income? Personal income is equal to the so-called NI. So, the income what we are making initially. So, personal income, in that we will take all the income. Number one, NI, national income, minus undistributed profit made by the company, minus interest payment made by the household, minus the corporate tax, plus transfer payment to the household. What do you mean by transfer payment? Whenever government is making a payment without any expectation, that is called as transfer payment, and that transfer payment is also seen as a risky thing because government dependence will increase to a large extent. And here we are also having the personal tax payment like income tax and non-tax payment. So here personal income minus personal tax payment minus non-tax payment. When you take all these things, what you get is called as personal disposable income as the final solution. And this is also important as such from examination perspective. And there is two terms called as real GDP and nominal GDP. Book will give you some very elaborate content, but I will make the concept very simple. When you take the GDP without subtracting something called as inflation, then that is called as nominal GDP. So nominal GDP, you will not subtract the price rise happened because of inflation. On the other hand, real GDP will be something where we calculate by subtracting the content on the topic called as inflation. So when we are subtracting the inflation and then arriving at the correct figure of the national income, it is real GDP. Without subtracting the inflation, if you arrive at the value, it is called as nominal GDP. Now, when you adjust this, when you go by the formula, that is, when you take the GDP deflator, it will tell what is the ratio of nominal GDP to real GDP. So, nominal GDP is 100. Real GDP is 50. So we can tell almost 50% the GDP right now is having a higher value because of inflation. For that only we go by the GDP deflator. At last we have consumer price index. It will tell what is the commodity or price paid by the end consumer when they are buying any commodity as such. This price rise and price fall will tell whether an economy is truly subjected to inflation or not. On the other hand, we also have one more formula called as wholesale price index, which will not measure the price from consumer point of view. Rather, it will measure the price from the element of wholesaler point of view. When wholesaler point of view, the content is getting measured, there are bright chances that we will skip the major area. And this major area in the sense, when you go to the wholesale market, price will be 100. In retail kirana store, the price will be 140. Now, which is the real price? Wholesaler, he can sell for 100, but retailer cannot sell for 100. In this area, we will have a mammoth amount of difference. Therefore, consumer price index is always seen as a better measure than other area. Next is GDP and welfare. So GDP, based on the distribution, we can say whether GDP is perfect or not. Number two, GDP is also subjected to non-monetary exchanges. So sometimes there are so many things like the role played by a mother, a homemaker in the family, which is not getting accounted. That also needs to be taken care. Externality. Sometimes unintended consequences happen, which may be positive or negative. Coke company coming near your home, negative externality. A sandalwood soap making company coming near home and it is giving the aroma of the sandalwood, that is a positive externality. So both of them needs to be taken care. So if you understand all these perspective, chapter number 2 will be very convenient to as such understand. Now coming on to the next area, which is called as chapter number 3, money and banking. So generally this chapter, why it is important is that without money and banking, there is no movement of Indian economy. So Indian economy is moving, it is able to thrive only based on something called as money and banking. That is the reason we will pay highest amount of interest in this topic called as money and banking as such. So earlier what we had is something called as the barter system. So exchange of goods will happen against the goods. In that, one of the biggest requirement is that double coincidence of what. So suppose if I want to do something, suppose if I want to as such buy, or if I want to make the utilization of, let's take urud dal, I need to find a person who needs tur dal, because I am having tur dal, I need urud dal. Only when both of us meet, we can exchange the commodity, otherwise exchange is not possible. One more thing, negative factor is that when we go by the aspect of barter system, value of a commodity cannot be ascertained. We will not know whether the value is right or wrong. When value of commodity is not there, then definitely speaking, no product will be subjected to real value system. That is the reason we have to go for something called as the so-called element of something named as money. Now what happened? Money is now being playing the role of medium of exchange. That means whatever you buy, whatever you sell, you can use money as a medium of exchange to proceed in this area, a highly acceptable norm. And in case of government, please understand what we are doing is we go by the universal formula of 1, 2, 5 for money printing. 1 rupee note, 2 rupee note, 5 rupee note, 10, 20, 50, 100, 200, 500. 1000, 2000, at max 5000. India has seen even 5000 rupee note also prior to emergency in 1975. So these conveys the message that government of India cannot print the note what they want. They can't go for printing 250 rupees. 350 rupees and all they can't print. They can print only in 1:2:5 and not any other value, because this is the international level of currency what they are following globally. And now what we are having is that first thing will be relating to the aspect of demand for money. So generally speaking, the question of money will come into picture because people will be having money for two purposes. One is for their transaction. They need to buy, they need to do some amount of transaction, they will have the money. That is the first function of money. Number two, for speculative purpose also they will have money. They will invest in some amount of bond and share and they will try to mint profit out of that area. So that is the second function why people always prefer to have money in their hand. So here whatever they are giving in terms of MD and T, all those things do not as such read. In prelims examination, nothing will come to your help. The concept what I am teaching is more than enough. If you go by diagram and other area, literally speaking, you are wasting your time only. Do not do that. Next is supply of money. Supply of money, who decides? In India or any country as such, the central bank will take the responsibility to decide on the supply of money. How much of money can be supplied, what is the quantum of money in the circulation, and what we can do to have an ideal amount of money supply. All these things will be devised by someone called as the central bank. In case of India, RBI does this function very clearly. So RBI is having a mandate. They are doing the work in this arena and they are very much comfortable also. because RBI will always ensure that they are not going to work as per vote bank politics and all. They will work only to ensure that the so-called economy is functioning in terms of proper principles and not to favor any particular caste-based member or any voter base and all. RBI is given the autonomy. In this area, RBI is the authority to decide all those things. Please go and read the functions of RBI, which is very important, and please understand the committee called as Young Hilton Committee was responsible for the commencement of Reserve Bank of India, and the brain behind commencement of RBI to have a proper centralized banking system in India was done by none other than Dr. B.R. Ambedkar. So just understand this formula. So first question is that the deposits in the bank are called as time deposit, because whenever you are making any fixed deposit, they will specify the time for its maturity, and government can decide all big policies based on it. Therefore, this is called as the time policy or the time deposit, because the time only will give you the maturity. If you go for any prior withdrawal, it will be a loss for the investor. Next, what we call is as fiat money. What is fiat money? Any currency and note and coins issued by the government is called as fiat money. Here, fiat money will not have intrinsic value. If you just melt the currency and all, you won't get anything bigger. A 2000 rupee note will not cost more than 4 rupees 17 paise. When that is the amount of money to print, when you go and tear the 2000 rupee note, you won't find gold or silver inside which is worth more than 2000. That is why there will be no amount of intrinsic value. They are also called as legal tender, because they cannot be refused by any citizen for payment of any transaction. Check which is drawn on a savings account or the current account, however, can be refused by anyone as a mode of payment. Therefore, demand deposits are not legal tender. Legal tender is only currency and coin. Currency and the coins printed by government. In this area, they say even when you go and deposit 1 lakh rupees in terms of 1 rupee, the bank cannot refuse. They have to wait, count all the rupees, and then they have to accept the element of deposit made by you. Without that, when they refuse it, it is again considered to be an unacceptable practice. Next, we have something called as M1. What is M1? M1 is called as narrow money. It is nothing but currency in hand and the demand deposits. Demand deposit means what? It is none other than CASA. What is CASA? Current account and saving account. When you combine the current account plus savings account plus the currency in hand, that is called as M1. Then what is M2? M2 is equal to M1 plus saving deposits with the post office. Generally speaking, government will call M1 as narrow money, because we cannot make any amount of big formulae by using M1. But M2, when you combine with M1, will give you some big idea. Therefore, M2 is being used to measure the level of inflation. Number 3, M3. M3 is equal to not M2, rather it is M1 plus the fixed deposits in the commercial bank. This is called as broad money, because this we can use to identify what policies government can frame. At last, M4 is equal to M3 plus the fixed deposits in post office excluding national savings certificate. So all FDs minus NSC will give you M4. So from M1, liquidity will be in the highest level. M2 it will reduce, M3 it will further reduce, M4 it will come to the lowest extent. This is termed as the so-called issue on the content relating to M4, M1, M2, M3, M4. Do understand these things are very important from examination point of view. Next is called as the Reserve Bank of India. Generally, RBI will be doing many functions. In that, first function is CRR. What is CRR? Every bank needs to maintain some amount of money in the form of cash with our great RBI. And this RBI funding, whatever they are saying, should not be subjected to any amount of activity other than cash. So whatever cash they are having, that they need to maintain, and the cash what they are maintaining should be kept not with them but with Reserve Bank of India. That is called as CRR. On the other hand, bank has to maintain some percentage of fund to their NDTL, that is net demand and time liability. current account, saving account, fixed deposit. When I take the summation of all, in that a percentage of fund they have to maintain with the bank themselves, not with RBI and all. That is called as statutory liquidity ratio. Then we have something called as bank rate, in which this is the rate in which long-term lending interest will be fixed. So RBI will have a bank rate in which the commercial banks can borrow the money not for the short term but for the long term. And here we have a rate called as spread rate. What is spread rate? For example, when you deposit money, interest is 6%. When you borrow money, interest is 9%. The difference is 3%. This is the profit for the bank, otherwise called as the spread rate. So spread rate is considered to be the profit margin for the bank, and collateral is nothing but the asset what we are pledging to take a loan from the banking institution. And here, what do you mean by high powered money? It is nothing but the currency note, the coins in circulation with the public, and vault cash of the commercial bank, and deposits held by the government of India and commercial bank with RBI. All these things put together will be called as high powered money. Do remember this point, very important, because they might ask you what do you mean by high powered money. Other formulas, other things are not required, so ignore these area. It will not have any amount of value in your preparation. Next is the instrument of monetary policy. What is monetary policy? What is the quantum of money which needs to be supplied? So it will deal about the money supply. It will also talk about the issue relating to how to as such control the inflation and promote the growth of economy. If you pump too much of money, inflation will increase, very dangerous. If you do not pump money, growth will not happen, again very dangerous. So we have to do something to ensure that these things are happening repeatedly. Therefore, in this area, one of the finest tool available is that monetary policy and Reserve Bank of India, both of them are being hand in hand working together for the vibrancy of the entire nation. So the topic here is very clear. So high powered money is all money possessed by the bank, individual, etc. And now we have to come to a conclusion, what percentage of this money can be allowed, and when it goes beyond a point of time, RBI will do the task of sucking the money from the market. They will not leave it because it may result in too much of inflation, otherwise called as hyperinflation, more than 1000%. RBI is also called as the lender of last resort. What do you mean by that? Lender of last resort is a very simple topic in which they say whenever the question relating to RBI comes into picture, when commercial banks are there, when people come and deposit money, people might have a fear that their fund, if a bank is having any loss, they might wind up also. To avoid all those exigencies, they have declared that if at all there is any amount of loss, don't worry, we will take care. We will ensure that the amount of money what you have deposited, we will come and do the justice for you. That is the reason it is called as lender of last resort. And again, debt financing through central banking. What is deficit financing? Deficit financing is a term wherein which whenever the question relating to the government is not having the fund to meet all expenditure. When the fund is not sufficient, where they will go for asking money? When every door is closed, the only door which is open is none other than our central bank. So when central bank is being approached to give loan, it is called as deficit financing, where the bank will give money with the condition that too only for short term and not for long term. What is open market operation? When you are doing the task of buying and selling of bond in the market, it is called as open market operation. It is a combination of buying as well as selling. It will not have only one element, rather it is a combination of both which comes into picture. Now what is buying? For example, bond is there. You are giving the bond to the public, which means you are selling. Always when I say you, it is the government. When government will sell the bond, they will give the paper, that is the bond, they will take the money from public. Therefore, when excess money is there, we will go for doing the task of selling the bond, taking the money. Now people do not have money, we will buy the bond from them and give the cash to them. So buying and selling, both of them will happen under the open market operation. Do understand this. So the question which is called as sterilization by Reserve Bank of India. What do you mean by this? Whenever any amount of foreign currency is entering into India, let us say 1000 crore worth of money is pumping inside India. The money got pumped. Now this 1000 crore should not create inflation. So what RBI will do, existing 1000 crore they will withdraw from the economic system via some scheme. When this fund is getting withdrawn, then it will not have any amount of adverse impact. That is the reason we go for the sterilization formula, right? So with this, we just move on to next one. So chapter number 4, that doesn't have any value relating to the economics of the prelims area. So number 4 chapter, we can ignore it completely, as this doesn't have any amount of valuable input for examination. So after crossing this, we'll go for the chapter number 5, which is called as the government function and scope. So what they are doing in this area, what is the scope and what is the function of the government, that we will deal in a detailed perspective. In this topic, before going into this, okay, so the functions of the government. Please understand, government is having a very important function which is called as the fiscal policy. Fiscal policy relates to Government of India's income and expenditure plan. How they are doing to achieve these will be labeled as fiscal policy. So what is fiscal policy? Why are we having the fiscal policy? Let us discuss all those areas one by one. Number 1. The goods are generally divided into two categories. One is called as public goods, which means the goods are being made available for each and everyone. There's no amount of restriction, all can use it. So whatever services the government are doing, roadway or a public issue, whatever it is, all these things put together will be labeled as public goods. On the other hand, we have something called as private goods. The dress what we are wearing, the car what we are possessing, the house what we are having, these are called as private goods. Now the government of India should be doing the task of allocation. What is allocation? The goods must be allocated in such a way that there is no amount of concentration of wealth. Number 2, government also should do something called as distribution function. In distribution function, government needs to make a very clear definition with respect to how they are going to take care of the distribution function. That is, how the income will be divided in a fair and transparent manner. When these two things are being done, the ultimate content is the government will have stabilization. When you are doing allocation, distribution properly, the government will find that the situation has now stabilized to a large extent, and this stabilization will be labeled as the achievement for the government. So all policies will be designed in this area. Now we will speak about the components of government budget. In mains exam also they asked what are the components of revenue and capital budget. It's a very simple thing taken from class 12 NCERT macroeconomics. Many questions were there in 11th economics called as the Indian economic development. So one message what I want to convey here, repeatedly from the NCERT area they are asking question. Therefore try to be equipped in these topics so that you do not have any amount of ambiguity when you approach the real examination. You should feel confident to go for the exam. That will come to you only based on consistent reading of NCERT. Sir, how many times I am supposed to read? Not less than 3 times. 3 times when you read, you will have a grip over the subject. You might ask, sir, why I have to go for 3 times? Why 3 times is, only when you read something for 3 times, you will remember that. Less than that, you will forget. Therefore, do not go for less than 3 times reading a given concept. Now we will deal about the revenue account. What is revenue receipt? Revenue receipt means anything which is coming to the government on a recurring basis. Recurring means repeated basis will be called as the revenue receipt of the government. So revenue receipt is generally speaking any type of income which the government is earning, not like a one-time income but repeated income. For example, personal income tax. whenever people start earning the money, they will start making the taxes to the government. So that is considered to be the revenue receipt initially. Next, this revenue receipt we can also make it into other heading, which is called as capital expenditure. So revenue budget has revenue receipt and capital expenditure. What are revenue receipt? Either you can get the income via tax or via non-tax. For example, jail fine or any type of penalty imposed. All these things are called as non-tax revenue, or the dividend paid by a public sector undertaking to the government is a non-tax revenue. So this is how the revenue is getting codified. Number 2, capital expenditure. One is planned expenditure, other is non-planned expenditure. What is planned expenditure? For instance, when you start something, let's say the 12th 5-year plan 2012-2017 becomes the tenure. In 2012 to 2017, when any expenditure is being planned by the government, if it is getting over within the 5-year tenure, it will be called as planned expenditure. On the other hand, when expenditure is going beyond 2017 to 2018, 19, 20, 21, it may go for 10 years also. That is called as non-planned expenditure. So these are the two differences. So in case of capital budget, we have capital receipt. What is capital receipt? I am selling my asset to somebody and getting the money. Long back, I gave him a loan. Now he is repaying me, a capital receipt. So any income which I get, wherein which my asset or liability in the balance sheet will change, will be called as capital receipt. What is capital expenditure? Buying plant and machinery, buying land, buying any asset will be labeled as capital expenditure. Sir, what about loan repayment? If you make the interest repayment, it is called as revenue expenditure. If you repay the principal, it is called as capital expenditure. Based on these heading, the differences generally take place. Therefore, we need to be very cautious in understanding the difference to a larger extent. So we have seen what is revenue, planned, non-planned, and we have seen capital receipt also. That is the amount of money what we get, which will not happen on repeated basis. For example, we may get great amount of revenue on repeated area, and we may get some amount of income on one time, which is called as capital receipt. And we have seen the expenditure made by government of India with a large amount of benefit, not only for the current year but for the future year also, will be called as the so-called capital expenditure of the government. Now, how the government will be having the element of budget? In this area, please have a look on this. Now we can have budget in 3 categories. One is called as balanced budget. So what is balanced budget? Here you will know that revenue will be is equal to expenditure. When revenue is equal to expenditure, it is called as balanced budget. Number 2, we have something which is called as surplus budget. What is surplus budget? Here we have something called as the revenue is greater than the expenditure done by the government. Therefore, surplus will come. Number 3, we may have something called as deficit budget. Sir, why sir deficit? Because in this area, expenditure will be more than the revenue of the government. This is how we codify 3 types of area in the topic called as budget. Consistently, what we have seen, have we witnessed a balanced budget? No. Typically speaking, it is a misnomer. We can never have the element which is called as the balanced budget. Because bringing balanced budget means exactly what is the revenue you are earning, only that we have to spend. So I don't think it is practically possible. So we can rule out this formula. Number 2, surplus budget. What do you mean by this? Revenue will be greater, expenditure will be lesser. How come revenue can be greater, expenditure will be lesser? It is not possible, no? Why? Because the logic here is that whenever revenue is great, whenever revenue is more and expenditure is less, it means the country has become an advanced country. Nothing is required. Everything is being taken care of by the people on their own. Then only we can go for surplus. When India is having more than 45% of people living under poverty, surplus budget we can never ever imagine also. Next is that we have something called as deficit budget. Expenditure will be more, revenue will be lesser, the Indian formula, the Indian method, what we are having to a large extent. So this conveys the message that the question relating to the aspect of deficit under this area is of prominent nature. So deficit will bound to occur. How we are managing that will only speak about our success. So first is that what do you mean by revenue deficit? When revenue expenditure is subjected to a larger amount of value, revenue receipt is a very less amount of income, then what we get is called as revenue deficit. Revenue deficit should not be there because that particular expenditure of revenue deficit is non-asset creating. Therefore, nobody will encourage this particular revenue deficit. Next is called as fiscal deficit. Normally we see in newspaper. What is this fiscal deficit? It means we can take this formula also for fiscal deficit. Number one, net borrowing at home within India. Number two, borrowing from Reserve Bank of India. Number three, borrowing from abroad. Only in these area we can go for the borrowing and not more than that. Therefore, whenever the question relating to the aspect of borrowing comes within the India, that is the from home, and within the Reserve Bank of India, and number three, outside the India, otherwise called as from abroad. When you sum up all these three, you will be getting something called as the fiscal deficit. Fiscal deficit will indicate how poor or how healthy an economy is there in general. Next, what we have is called as primary deficit. What is this? Sometimes speaking, the amount of interest payment will be enormous. Out of every 1 rupee spent, we are spending more than 20 paise on interest payment. So interest payment sometimes will be very high, and interest payment will not be our responsibility. Previous government would have taken huge amount of loan. They would have failed to make the repayment, and for that we will be paying the loan. You see the irony, it's a very tough thing. In this area, as this happens to a large extent, people feel extremely bad, and therefore for identifying the efficiency of that government, we have a new formula called as primary deficit. In that, what they will do, they will take the gross fiscal deficit and they will subtract the interest liability, the interest payment. Whatever loan has been taken by the previous government, all those interest, whatever we are having, those things will be subjected to a great amount of subtraction. Once they do that, then we can come to a conclusion that the so-called the primary deficit will reveal how efficient we are. When you see at the numbers, you will know how big this will have an impact. For example, you take 2003-2004, fiscal deficit for the government is 4.5 and primary deficit is just 0. This means what? Current government does not have any deficit. They are able to run the government perfectly. But why we are having deficit is previous government took so much of loan, we are repaying the interest for that. That is the reason we are having the pain. You see all the example. 5.6 fiscal deficit, 0.9 primary deficit. 6.2 fiscal deficit, 1.5 the primary deficit. 5.9 fiscal deficit, 1.1 primary deficit. When you take all these things, it conveys how generally the government can measure their performance using this methodology. Next, what we have is called as fiscal policy. Fiscal policy is always something dealing with the two things. One is the aspect of income, other will be the aspect of expenditure. How income and expenditure are being manned, that will be labeled as the fiscal policy of the government. And then additionally in this area we'll go for other topics as such, for example, discretionary fiscal policy. Therefore, when there is a deliberate action to stabilize the economy, it is called as discretionary fiscal policy. When they are doing not based on demand and supply, they are doing it on their own to stabilize the economy, that will be labeled as a discretionary fiscal policy as such. Next, government of India also will be having something called as debt. Debt is always dangerous. Generally speaking, there is a universal formula, not only for UPSC economics, in real life also. A man who doesn't have a debt is considered to be a rich man. A man having debt is not called as a rich man, because debt is always subject to trouble. We have seen giant people getting trapped because of debt. That much of power debt is having. Therefore, debt should not be subjected to any economy. But Government of India goes for great amount of debt as we do not have any other option as such. How to reduce the deficit? We can increase the taxes, we can increase the taxpayer base, we can reduce the expenditure, we can bring rationalization in all subsidy, we can sell the non-functioning PSUs to private. If you do all those things, government will have some amount of positivity as such. And then please have a look upon the FRBM Act which was recently amended. So please refer to N.K. Singh committee which gave the guideline for FRBM Act. Because Fiscal Responsibility and Budget Management Act, what they said initially they were not able to achieve. Now they have rephrased by using N.K. Singh committee. So what are those recommendations and guidelines? Please have a look into that area. And now coming to the last chapter as such, we will deal about the open economy or macroeconomics. Right now what we are having in case of India is that we go by the principle of what is called as something globalization. We are always open to globalization. India feels that the growth of a nation is only possible via globalization. In the absence of globalization, growth can never happen. That is the ideology what we are having. Therefore, more thrust is being made towards globalization. Right. So when you are going for globalization, what are the terms linked in that area? We will know it. If you know that, the chapter gets completed, right? So with that topic, we will start about the first one called as open economy. If you know, in prelims exam, they asked, what do you mean by closed economy? They were wondering, come on, UPSC is taking question from unknown area. No unknown area, from known area only. Here they are talking about open economy. No, if you read this, you will know what is closed economy. An economy which is permitting trade and other transactions with other parts of the world will be called as open economy. An economy which does not permit these things will be called as closed economy. So open economy and closed economy are these two things where in one area they permit the foreign trade, in other area they shut their doors, do not permit for any amount of movement of goods and service, movement of people to any part as such. This is one condition coming under the area which is called as the so-called economy under the open economy. Closed economy means fully closed. The name itself says no transaction, no trade, nothing. That will be labeled as closed economy. Now here, in case of India, degree of openness will tell about the foreign trade. If you are more open, many companies will come to your country. If you impose unnecessary, unwanted restriction, you cannot proceed. That is the reason there are several countries whose foreign trade is almost 50% of their GDP. 50% of their GDP is coming only from foreign trade, because that conveys the message that these countries are subjected to a large amount of positivity. Next is that international monetary system has been ensured, is being specifically given the task to make all transactions in the international arena to a smooth perspective. And now they are dealing that, and we have IMF, World Bank, all are there to bring stabilization. And then we have the term called as balance of payment. What is BOP? See, BOP is a very simple term which I can tell that it will account all amount of transactions happening from India and to India. So from India, any goods going outside India, and to India, any goods coming into India. When this is being subjected to a great amount of measurement, that will be called as balance of payment. So balance of payment is considered to be a record in the transaction of goods, service and asset between the residents of a country with the rest of the world. There are two main accounts in balance of payment. One is current account, other is capital account. If it is like normal trade, in trading what we will do, we will buy and we will sell the commodity. That will come under current account. If you buy assets as such, that will come under capital account. So current account and capital account put together will be talking about the balance of payment. Therefore, be very specific. So current account will record the exports, the imports and transfer payment. What is transfer payment? Unilateral transfer of fund is called as transfer payment. Government giving pension to old age people is a classical example of transfer payment that we will take. And now here the content is that any transaction in the foreign account which is giving an element of positive sign will be called as credit. Any negative sign will be called as debit. That is the area in this topic. Next is BOP surplus and deficit. So what is balance of payment surplus and balance of payment deficit? BOP surplus and deficit conveys the message that whenever our balance of payment is surplus, it means our transactions are giving good amount of income for India. On the other hand, when BOP is in deficit, it conveys another message that our BOP is not something subjected to acceptability. This present stand of BOP doesn't have a proper amount of acceptability. Therefore, we need to change the foreign trade policy to make more amount of money. So making more amount of money will become a possibility only when we go by this particular formula. Next is that we are also having the transaction which is called as accommodating transaction. So accommodating transactions are determined by net consequence of autonomous item, that is whether the BOP is in surplus or deficit. The official reserve transaction are seen as accommodating item in BOP. And here some items will not come under any account, current or capital, and those are called as errors and omission. And then we have another term called as forex market. What is forex market? If you ask, it is nothing but than the online market. In online, how we are buying and selling the share synonymously when we are doing the content of the buying and selling of international currencies in online market, that is called as foreign exchange market. Forex market will speak about the strength of a country, the ability of a country. Better the forex market, better the vibrant system. And now how the exchange rate will be there, how they are fixing $1 is equal to 80 rupees, 85 rupees, how this value comes into picture. Earlier and all, we had something called as fixed exchange rate system. They will have a basket of 5 or 6 currencies. When those currencies appreciate, our value also will increase. When those currencies depreciate, our value also will decrease. That was the old formula. And now what we are having is, we are going by the method which is called as the element of exchange rate based on not the fixed currency but based on law of supply and law of demand. Whenever the currency is in high demand, then the price will increase. When currency demand got declined, then the currency will not have proper value system. This is what the element of model what they were following earlier. And now in case of India, they also speak about purchasing power parity as a concept. So what do you mean by this? For example, if you take 100 rupees to America, you can buy maximum 1 milk packet. I don't know even that we can purchase or not. Now, if you bring $1 to India, you can buy at least 3 milk packet sold by state milk cooperative federations. So this says the element of purchasing power for America is very high compared to the Indian rupee. This is only called as purchasing power parity. Purchase means the ability to buy something. Power means the strength or how strong the currency is. Parity means in comparison. So purchasing power parity is considered to be the domain where we speak on the perspective of how a currency is becoming strong or how a currency is becoming weak as such. In this area, we have something called as near and rear. So what is this near and rear? Generally speaking, near is considered to be a multilateral rate representing a basket of foreign currency, each weighed by the importance to domestic country in international trade. So compared to nominal exchange rate, in real exchange rate, what is the difference? In real exchange rate, we come to know about it has been calculated as the weighted average of real exchange rate of all trading partners, the weight being the share of respective country in the foreign trade. It is interpreted as the quantity of domestic goods required to purchase 1 unit of given basket of foreign currency. So earlier here they will have a basket of currency in NEER. In REER they will have the entire amount of exchange rate with all trading partners, so that we come to know about exactly how much of money is required in the international platform to either buy or sell something. Next we have something called as exchange rate. We are having first is flexible exchange rate, also called as floating exchange rate. It is purely based on the demand and supply in the market. Higher the demand or lesser the demand, the price will increase or decrease. And number 2, we have something called as appreciation. When $1 is 80 rupees, if it is sold for 60 rupees, this is called as appreciation. 80 to 60 is not depreciation. 80 to 60 is called as appreciation, because earlier you need 80 rupees to buy $1. Now the same $1 will be given to you when you pay just 60 rupees. And then what is speculation? Whenever the money is being used to predict the market or to use the money to mint money, it is called as speculation, and this speculation is highly restricted because it will create huge amount of impact on the growth of economy. Fixed exchange rate system was done prior to 1970, which is called as pegged exchange system. The word peg means to fix. So fixed exchange system is not that so correct, because that will only talk about a few currencies and their value will determine the value of domestic currency. Now we have a term called as devaluation, where we artificially reduce our value. We bring depreciation not happening naturally, rather we do it artificially. Revaluation is trying to bring back to normalcy what damage we have done by way of reducing the currency value. And then we are also having managed floating. This means partly fixed, partly floating. When we have the combination of these two, it is called as the so-called managed floating system. Then Bretton Woods system, that is the reason we are having the emergence of International Bank for Reconstruction and Development, plus we are having the emergence of IMF. And these are the areas which we need to remember. And other than that, is there anything to be as such understood? So in this chapter, all these diagrams and other things, please ignore. Don't read these area. This will not give any amount of value to the examination. So safely speaking, we can ignore these things, right? That's it. So with these things, we can come to a conclusion that this chapter contains only this much of treasure point to be read for the examination. Do that. That is more than enough to clear the examination. Now we'll just have a look relating to other topics, that is called as the MCQs what we have planned for current area. Yes. So please just come to this topic. We will be having a great amount of interpretation relating to the NCERT economics quiz. Number 1. Consider the following statement. Subsidy is a payment that a government makes to a producer to supplement the market price of a commodity. Subsidy can keep the consumer price low while maintaining a higher income for domestic producer. Now when you look at both these statements, number 1 says subsidy is a payment that a government makes to a producer to supplement the market price of a commodity. When prices are very high, when government gives a subsidy, the price will come down. Yes, universally known to everyone. Number 2, subsidy will keep the consumer price low while the income for producer will be compensated by way of giving the money. Now both the statements are correct. We'll tick it as C, both of them. But question is asking which of the statements are not correct. You see, sometimes we may have a trap in these area. Be very cautious. So answer for this is Delhi. D. Number 2. Consider the following statement. We compare the average income, which is the total income of the country divided by its population. The average income is also called as per capita income. Absolutely correct. Per capita income is nothing more than the total amount of income in the numerator divided by total population in denominator. When you take these two parameters, it is called as the so-called answer on per capita income. Per capita income will truly tell how the growth of economy has taken place, because when national income is increasing, simultaneously when the population is also increasing, per capita income will not have a good amount of growth. That is the reason they say per capita income is more a better gauge to measure the economy than by going the normal method of GDP formulas. Next, number 3. Income by itself is not a completely adequate indicator of material goods and service that citizens are able to use. Money in your pocket cannot buy all the goods and service that you may need to live with. See, you may have money, but right now, suppose if you are living in Delhi, now Delhi is flooded. Our Chief Minister Arvind Kejriwal is saying that you please send some paramilitary force. We are not able to take care, including the residents of Arvind Kejriwal. Everywhere we find flooding. So sometimes what happen, what we plan will not happen, and what we do not plan will happen. Therefore, money alone cannot give happiness. Number 2, income alone will not give adequate amount of goods and service that citizens are able to use. A man will be a richest man. He will be having kidney failure. He will go for dialysis. He cannot even drink water to the extent what he likes. He cannot even go for consuming sweets like what he wants. His life will be controlled to a largest extent. Therefore, both these statements are correct. Number 4. Which of the following are the features of unorganized sector in case of India? Number 1. Small and scattered unit which are largely outside the control of the government. Yes, absolutely correct. These are not coming under the regulation of the government. That is why we call them as unorganized sector. Number 2. There are rules and regulations, but these are not followed. Yes, the rules and regulations are not being taken care by these people, because these rules and regulations, if they are following, they will come under the organized sector definition. Number 3. People may not be employed by anyone but may work on their own, but they too have to register themselves with the government. So in this area, people may not be employed by anyone, and here they may work on their own, but just they have to get registered that I am coming under the unorganized sector. If you look at this chance, 1, 2, 3, all the options are correct with respect to the something called as unorganized sector in case of India. Whenever we are having higher amount of unorganized sector, the labor class will be facing a big amount of problem. Next, a check is a paper instructing the bank to pay a specific amount from the person's account to the person in whose name the check has been issued, right? So a man who writes will be the person where his account will be debited, to whom he is writing will be getting credited. Number 2, for payment through check, the payer who has an account with the bank may use a check for a specific amount. So for payment through check, the payer who has an account can make a check and tell this is the amount of money I am willing to give you. If you look at both these statements, we have the strongest conviction that yes, both of them are correct. Therefore, answer will be C, 1 and 2. Sixth one. In India, RBI issues currency note on behalf of the central government. Statement number 1. Statement number 2. The law in India legalizes the use of rupee as a medium of payment. I told you fiat currency is currency and the coins. So currency note and the coin, both of them are being used. So nobody can refuse this. An individual in India can legally refuse a payment made in rupees. Absolutely not possible. If they are giving check, if they are giving DD, we can refuse it because they are not fiat currency. They are not subjected to a compulsory form of acceptance. But here we can reject them. Therefore, option 1, option 2 is right. Option 3 will not come. Question number 7. A MNC is a company that owns or controls production in more than one nation. Multinational company is a company that owns or controls the production in more than one country. Absolutely correct. Then investment made by MNC is called as foreign investment. Yes. So when any amount of funding is being made by these MNCs, it will be labeled as foreign investment, and this investment in turn is being subjected to a great amount of funding for the growth of the self and growth of other nations also. So both 1 and 2 are right. Question number 8. Tax on import is an example of trade barrier. So when we give large amount of tax on import, importing that goods will become a costly affair. Therefore, tax on import is considered to be a definite example for trade barrier. Number 2, government can use trade barrier to increase or decrease foreign goods only, not required. We can impose even tax domestically to even contain the production, distribution, sale of a given commodity. Therefore, there is no rule that only for foreign commodities we can go for this area. And here statement number 1 is right and statement 2 is incorrect. Question number 9. Removing barrier or restriction set by the government is called as liberalization. Liberalization of trade, business are allowed to make decisions freely about what they wish to import or export. Number 3, government imposes much less restriction than before and is therefore said to be more liberal. So government is having the element of lesser restrictions than they were having earlier, and all the statements are true with respect to globalization what India is facing. Question number 10. During the colonial era, the assertion is that during the colonial era in India, there was some evidence of relatively higher yield of cash crop in certain areas of the country. The reason is there were negligible use of fertilizer. Not only this, so in this area, the question is asking about this content. So both the statements are true, but for the element of higher yield of cash crops, many are there. So fertilizer, use of other alternates available, irrigation facility, so many are there. And here the reason what they are explaining is not the correct thing as such. So both of them individually are correct, but the second statement doesn't explain the statement number 1. Therefore answer is B, Bombay. Question number 11. Consider the following statement about the statistician P.C. Mahalanobis. Second 5-year plan in case of India is based on this person only. He was educated at the Presidency College in Calcutta and Cambridge in England. He was made a Fellow of Britain Royal Society. He established Indian Statistical Institute in case of Calcutta. 1, 2, 3. All are factually correct based on NCERT. This statement is true. Question number 12. Why the goal of equity was not fully served by abolition of intermediary? Why we are not able to do this thing? Number 1, in some area, farmer zamindar still had huge amount of land. They used the loophole in the legal system. Number 2, the poorest of the agriculture labor did not benefit from land reform. And that is also there. Only big size landlords, they got the benefit. And number 3, there were not same level of commitment in all the states to abolish the intermediary. 1, 2, 3, all the 3 are the reason why we are not able to achieve the goal of equity. Concept of jail cost of living. To calculate the element of what is the per capita income, Dadabhai Naoroji went for this. In pre-independent India, Mahatma Gandhi was the first to discuss the concept of poverty line. No, it was done by Dadabhai Naoroji. Then number 2, Gandhi used the menu for a prisoner and used appropriate prevailing price to arrive at what may be called as jail cost of living. No, this was also done by our great person called as Dadabhai Naoroji. So statement 1, statement 2, both of them are wrong. Statement 14, the self-help group promotes thrift in small proportions by a minimum contribution from each member. So from the pooled money, credit is given to the needy member to be repayable in small installment at reasonable interest rate. This is the very basic objective of self-help group. They will mobilize the money, give it to all the members, and that in turn will be repaid in small installment. So 1 and 2 both are right. Question number 15. Which of the following will be added to factor income from net domestic product accruing to the private sector to get the private income? What all will come under the private income as such? National debt interest, net factory income from abroad, current transfer from the government, other transfer from rest of the world. In this area, 1, 2, 3, 4, all the choice will be combined together to arrive at the so-called private income, right? So with this, we will just wind up the area on the quiz topic, and the entire content of NCERT is also over. We will meet in some other classes as such and discuss the content on UPSC. Thank you.